Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, there has been a huge change at the Japan Central Bank, which Japan was the last country that had negative rates. And a week ago now, they shuttered that and have basically said that they're joining the rest of the world and having positive interest rates. That has enormous implications, not only for Japan and Japan's economy, but also perhaps the rest of the region and the world.
Yeah, no doubt. One time I remember looking at the biggest owners of ETFs in the world, and because we were really trying to find how big is the Merrill Lynch model? How big is the BlackRock model? And above all of them was Bank of Japan. I forget, it was a couple $100 billion worth of ETFs.
It's up to $500 billion now of
amazing.
ETFs.
I mean, they own 75-80% of all the market. It's really wild. It's almost feels a little like socialism, where the bank owns all of the stocks. And that was an interesting story for a long time. Again, as somebody in the U.S., only a couple international stories get my interest of the year, but that one definitely did.
But now that they're changing this interest rate policy, they're also going to stop buying ETFs. What happens with this massive hoard of ETFs is a big TBD. But what really caught my eye was that, and this was Rebecca Sin, your colleague at Bloomberg Intelligence, in Hong Kong, who wrote that China has looked at Japan and basically said, we want to get in this ETF game now too.
Joel, I remember being in the Philadelphia International Airport, 3 or 4 weeks ago, waiting for a flight, eating breakfast at Bud & Maryland's, which is a great place. And I got an IB from Rebecca talking about China, and I was like, wait a second, China's buying ETFs? And I didn't know this. And then we started looking at the investors there all coming to the U.S. and how they're trying to save people from leaving. And I was like, holy moly, this is a massive story. This is really something. Does it help China's market go up? Because it's in the gutter. How much do they buy? Do they go on BOJ's level? It's one of the biggest ETF stories of the year, no doubt.
And joining us on this episode, Rebecca Sin, who's an analyst with Bloomberg Intelligence. She's also about to launch her own podcast here called Tiger Money in April. This time on Trillions, why central banks love ETFs. Rebecca, welcome back to Trillions.
Thank you for having me.
Okay, Rebecca, I want to start with Japan because for years now, they've been buying ETFs. How has that gone and why have they been buying them?
So the background for those that may not know is that this is the first time that Japan has had a rate hike in 17 years. So think of that, 17 years where they've either been in negative or zero interest rate. And so the Bank of Japan started buying ETFs in 2010. And the reason why they did this was ultimately to support the market. And what some may not know is that the market, so the Nikkei, rallied as much as 57% in 2013. And ultimately, they've amassed a huge position of ETFs, roughly $475 billion worth of ETFs. And so this is roughly 80 to 85% of the ETF market in Japan. But to put that into perspective, it's only about 7% of the entire Japanese stock market. So it's not that big, but they've ultimately finally said that now they're not going to buy any more ETFs. So this is the first time in 14 years.
Okay, so they have this massive pile of ETFs. I believe the Japanese stock market did hit all-time highs. My friend and colleague Todd Sohn at Strategis pointed out that the last time Japan hit an all-time high, Michael Keaton played Batman, and now he's playing Batman again. So just FYI, I don't know if it's correlated or causation, but
I'm going to go with correlation.
Are they going to sell the ETFs now or just live with all of this on their balance sheet?
So they really have three options. The one is sell the ETFs, but ultimately that's going to create a huge shockwave to the market and drag the market down. So no one expects that to happen. Another option is that they could potentially hold the ETF forever. Ultimately, the ETF is paying dividend, which is a big part of the central bank's earning. I think the most likely scenario is that they pause, so they do nothing, and they try and sell the position over several years, if not decades. And so I think everyone expects that to be the likely scenario. They do have a few other interesting ideas that their advisors have suggested. And one of them is that the government could take over the ETF and issue a perpetual bond to the BOJ to move it off its balance sheet. Another one, which I thought was interesting, was someone had suggested gifting ETFs to young adults to help boost security ownership. So for instance, when everyone becomes an adult, by default, they get an ETF. And I was like, oh, that's quite an interesting idea. And I don't think any economy has done that. But I think ultimately the expectation is that they're going to do nothing, pause, not buy anymore, and then in hopes of over the next decade, start selling off these ETFs.
We're at this little bit of a wait and see moment with Japan, while Japan also has this huge pivot with their interest rate policy and leaving this negative interest rate moment behind. What I was really curious about, of course, is China. So has China just quietly been watching Japan for all these years and wondering if this is some textbook maneuver that they might be able to do a copy and paste exercise with?
I think China has had a struggle in their economy. Last year, the CSI 300, which is equivalent to the S&P 500, was down 15%. And I think one of the ideas that was proposed was perhaps buying ETFs like Japan. In terms of scale, in terms of assets under management, Japan ranks first in Asia Pacific with roughly $550 billion worth, and China is second with roughly 350. And so perhaps they thought that maybe to boost their assets under management, that they could start buying ETFs. But what's been interesting this year was how much they bought and how quickly. So to put it in perspective, year to date, the central bank, also known as the China National Team, which is a sovereign wealth fund of China, has bought roughly $45 billion worth of ETFs. And to put this into perspective, just last year, China onshore only got about $70 billion in assets. So this is half the amount in only 3 months. 3 years ago, China only had $4 billion in net new assets. So this is a huge amount. And our expectation is they can buy as much as $100 billion by year end. So this would be roughly a third of the entire market, which is a huge amount in a very short time.
Joel, let me go over $45 billion in terms of their market. That would be like the Fed buying $855 billion worth of ETFs here. I mean, that is no joke. That's a lot of money.
It's a lot. And it's also, I mean, it's bigger than Japan, right? Which had been doing this for a decade.
And it's interesting that a lot of investors like to say, don't fight the Fed, especially if they're doing asset purchases. I don't even know how many people know the China National Team is doing basically what the Fed was doing for the past 15 years, but like on steroids. It'll be interesting to see if the market goes up, because just that act alone might attract people to buy into it, being like, hey, I'm going to instead of not fight the Fed, I'm going to not fight the Chinese national team and make money on this. Like, it should work, right?
Well, it worked in Japan, right? But they also were also patient about it. Rebecca, how do market participants feel about this? Because it's not the Japan decision wasn't controversial.
So what happened was when the national team started buying ETF, they bought the CSI 300. And this didn't really have much impact on the market. And one of the reasons was potentially that a lot of the companies in the CSI 300 are state-owned. So it's already owned by the government. And so it didn't really have much impact. So what they actually started doing was started diversifying away from the CSI 300 and started investing into small cap. And once they started doing that, the market did rally. So for instance, there was one day where they bought into the small cap ETFs, and then all of a sudden the market rallied 11%. So I think that it is working, but they need to be more selective on the types of ETFs that they did. So China actually the national team bought ETFs in 2015. And what they did back then was that they only bought to the largest ETF issuers. And ultimately, that didn't benefit the whole market. So what they're doing this time is they're having a more equal distribution to all the ETF issuers based on their size of assets under management, so that everyone in essence gets a piece of the pie.
You know, that's interesting. Remember in COVID 2020, when the Fed stepped in to buy bond ETFs, when they decided what to buy, they bought based on the percentage the issuer had of market share. So in fixed income, BlackRock has 50%, then Vanguard has probably a quarter, and then down the line. And their portfolio really reflected that. What was also good is they bought bond ETFs that didn't just own the same bonds over and over. They did go down into different areas. So it is interesting to see how the central banks size up the market and how to make an impact. I also remember writing a story back, 6, 7, maybe 10 years ago. I don't know, time's flying, Rebecca, about how the Bank of Japan, it had the same issue. It was buying the large caps, and it thought to itself, we should actually be buying companies that spend the most money on CapEx and R&D. And so they had iShares create these human capital ETFs. That way the money would get passed through to the real economy as opposed to just making its way into like dividends in like people who own stocks pockets, which is part of the issue with the Fed. They said, okay, you're lifting up the stock market, but that's just making the rich people richer. How does that actually help the actual economy? And I don't know, it's interesting to see them like learn as they go.
So off the back of that, in Japan, when they first started doing this ETF purchase, they were purchasing Nikkei 225. But to your point, it wasn't really helping the market or not enough. And so they started diversifying. And instead of going to Nikkei, they started going to topics because topics was a more fair representation of the entire market. And so I think in China now we're seeing the same thing. They initially started with CSI 300, which is the large cap company. And now they're going to all the small caps. And so I think central banks are learning from past mistakes. This time they're improving. They're going to all ETF issuers. They're trying to diversify to not just one index, but multiple index. So I think it's interesting to watch and see what they do and where they invest into.
So if China's national team keeps this up, Rebecca, they go from 45 billion of ownership currently to, let's say, 100 billion by the end of the year. What are they looking for? How will they know that they've succeeded?
I think ultimately they're looking to stabilize the market because what was happening was that Chinese investors were being burned by Chinese equities. They were not performing. And so they were fleeing to ETFs listed in China with foreign exposure. So likes of S&P 500, MSCI USA, Nikkei. And some of these ETFs started trading at a 43% premium. And so when Eric heard about this, he's, what? ETFs are trading at a 43% premium and people are still buying into it? He was shocked. And in China, what happens is if the ETF trades at a 10% premium, there's what's called a premium warning. It's a warning to investors that this ETF is trading at a premium and it gets halted during the first hour of trading. And what we noticed was that the ETFs that had the most halt got the most inflows. And in China, there's a QD system, which is Qualified Domestic Institutional Investor. And this is the quota that goes into foreign stocks. And what was happening was all of these fund houses, their quota was being reached because retail investors were investing into S&P 500, MSCI USA, Nikkei. And so these ETFs not only couldn't create, but their trading was halted and they had a huge demand. And so they were in essence trying to solve this problem. And so they said, look, we know people are going overseas. People are looking for better returns. Let's start investing in our own economy and see if this will boost the market. And so this is really why they started, I think, potentially investing into ETFs listed in China.
Yeah, this part of the story really intrigues me because you've got all these Chinese investors, and there's a lot of them, and their market is in the gutter, and they're trying to save for retirement. And they can see the U.S. just going crazy every year. The Q's just crushing it. And they're getting this FOMO, understandably. But they can't really get over here. And because of the quota and the Chinese government, they have to pay this premium. And so not only are they buying into the U.S. market, which is at all-time highs, they're buying into it at 30-40% premium on top of that. And they're leaving a market that's like in the gutter. This just feels like it's going to end in tears, Rebecca. Like, it's almost like you can just sense the timing is bad. You're supposed to buy low and sell high. They are buying really high and selling really low. Am I wrong?
Yeah, so I think that's why the national team has stepped in, because ultimately they want the retail investors to invest in their own market. And an interesting stat about the China market is that it's roughly 75% retail. So institutions really don't play that much. And it's only really this year that we've seen institution increase because of the China national team. So from a retail perspective, yes, they're being burned because they didn't make money on China. Now they're going into the US market at an all-time high plus the premium. And so there's definitely a lot of caution needed for these investors.
Give us a rundown here. So the Chinese market has the central bank buying in, and the Bank of Japan has stopped. So where do these two countries sit on like the top 10 list by ETF assets in Asian countries? And do you think we'll see like China overtake Japan?
So I do think that China could potentially overtake Japan as quickly as 2 years. And the reason for that is in terms of assets under management, Japan ranks number one with roughly 600 billion in assets under management. But Japan has actually slowed down significantly in the recent years. And so with the Bank of Japan not buying ETF, they really have to grow the market organically. And that's why in Japan, they launched this new program called the Nippon Individual Savings Account, which is a tax-free stock investment group aimed for investors to really invest into the market. So it's kind of like your 401k in the US where there's tax-free when you can purchase ETFs tax-free. And so I think mainland China could surpass Japan as quickly as 2 years in terms of assets under management and become number one. This could even go as quickly as 1 year if the national team keeps buying at the rate that they're buying at. So it'll be interesting to see who is number one in the next few years.
And let me ask you a question. Like, say I went into China and I walked 1,000 miles through the country and I asked everybody that I came in contact with, do you know what an ETF is? What percentage of the people would say yes?
I would say most people don't know what it is because in China, a lot of the main way that people invest is through their mobile phone. And so it's through these mobile payment apps like Alipay and WePay that people can invest in. Most of these products are money market funds. And so I'd say ETF is still relatively new and there's still a lot of education to be done. But the other challenge that China faces is they have more than 70 ETF issuers. And so from a marketing perspective, it's very hard to compete against because when you launch one product, there's no unique feature. You usually have 10 to 15 ETF issuers launching the exact same product at the exact same time. So think of your Bitcoin ETF having 11 ETF issuers launch at the same time, happening for almost every single launch. So the competition is fierce.
Muddy.
And so in terms of brand recognition, it's
a muddy place.
Very difficult.
Yeah.
It's a very competitive landscape.
I'm curious if we take Eric's 1,000-mile journey through the countryside and ask the same thing in Japan, would there be much of a difference?
I would think that Japan, you'd probably have more people that know about it because Japan's had ETFs since 1995. Mainland China only started ETFs in 2004. And so the time difference, I think, does help. And Bank of Japan has been buying ETFs for 14 years.
Yeah.
And
it's been headline news for a while.
Know about it. And the thing is, in Japan, they launched this NISA program, which is aimed at individual savings account. So that means that they have sufficient retail demand to know what this is. While in China, I think if Eric were to walk 1,000 miles in China, I would say 50% would not, at least 50% would not know what an ETF is.
I would walk 1,000 miles to see if anyone knows about ETFs.
Okay, Rebecca, this was a fascinating comparison between Japan and China. What else, as we wrap here, what else should our listeners know about ETFs in Asia?
Hong Kong is going to launch the first spot Bitcoin, and we could see the first launch as early as May. And what's interesting about this is Hong Kong's going to take in-kind creation. And so Bitcoin in, ETF out. And so this could be groundbreaking for Asia. Given the success of the US with the spot Bitcoin ETF, this is a very interesting space that we're watching very closely.
Apparently in the US, the SEC didn't want to do in-kind creations and redemptions because they thought that bad people would use the ETF to launder money, but they might go to Hong Kong to do it.
I'd say everyone should watch out for Asia Pacific right now because we currently have, as of December 2023, $1.5 trillion in assets. And we may very quickly surpass Europe in terms of assets under management, especially with the rate of where mainland China is going, the growth in India, Taiwan. ETF assets in Asia Pacific can surpass Europe as quickly as 2 years.
Oh.
So watch out.
This sounds like a bet on the BI team.
I agree. By the way, that should be a note. You should definitely write that. Asia's going to pass Europe in 2 years. Something like that. That's how we think of notes on the team. Right there. You just had a little insight, Joel. You want, which I think it's enough.
It's enough. I get it. Rebecca, thanks for joining us on Trillions.
Thank you for having me.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you like to listen. We'd love to hear from you. We're on Twitter. I'm at Joel Weber Show. He's at Eric Balchunas. This episode of Trillions was produced by Magnus Hendrickson. Bye.